Hey everyone, welcome back to the Investors Community channel. I'm excited to share some seriously valuable insights with you today, especially if you're looking to build long-term wealth and make your money work harder for you. Remember to hit that like button and subscribe so you don't miss out on future videos. Today we're diving deep into the world of Warren Buffett. You know, the Oracle of Omaha, the guy who built a multi-billion-dollar empire through smart, strategic investing. He's considered a legend for a reason, and the best part? His strategies aren't some big secret. He's been pretty open about his approach, and it's something anyone can learn from. We're breaking down the top 10 investment rules that have led to his incredible success. Trust me, these are golden nuggets of wisdom you'll want to write down and keep handy for your own investment journey. Whether you're just starting out or have been in the game for a while, these principles can make a real difference in how you approach the market. So, let's get started. Alright, let's kick things off with rule number 1. Invest in what you understand. Buffett's a big believer in sticking to what you know. He's all about understanding the businesses he invests in, inside and out. He avoids getting swept up in trendy sectors or complicated financial instruments he doesn't fully comprehend. Instead, he sticks to industries and companies he can confidently evaluate. This means understanding their products, their services, their competitive landscape, the whole 9 yards. Identify your areas of expertise, whether it's technology, retail, or healthcare, and stick to investing in those areas. Don't feel pressured to jump on every hot stock tip or follow the crowd into unfamiliar territory. So, stick to your circle of competence, do your research, and invest in what you know. Now let's move on to rule number 2. Focus on the long term. Buffett is famous for saying, "Our favorite holding period is forever." He's not in it for the quick buck, the short-term gains, or the latest market fluctuation. He's playing the long game, aiming to hold his investments for years, even decades. Compounding is like this magical snowball effect in investing. Your returns start generating their own returns, and over time those gains snowball into something much larger. This long-term outlook isn't just about maximizing returns, it's also about peace of mind. It allows you to ride out the inevitable ups and downs of the market without panicking. Patience, discipline, and a long-term perspective are key. Alright, moving on to rule number 3, seek out competitive advantages. Buffett uses a great analogy here. He talks about investing in companies with a moat. In the business world, a moat represents a company's sustainable competitive advantages. It's what sets them apart from the competition and protects their profits. Look at some of Buffett's most successful investments: Coca-Cola, Apple, Geico. These are all companies with incredibly strong moats. When you're looking at companies to invest in, ask yourself, what are their competitive advantages? What sets them apart? Do they have a strong brand, a loyal customer base, a unique product or service? You want to own businesses that are built to last, businesses with strong moats that protect their profitability. Now, this next rule, rule number 4, might be one of Buffett's most famous. Be fearful when others are greedy, and greedy when others are fearful. This is all about contrarian thinking, going against the herd mentality that can often lead investors astray. When markets are booming, and everyone's feeling euphoric, it's easy to get caught up in the frenzy, but that's precisely when Buffett gets cautious. On the flip side, when markets crash and fear takes hold, that's when Buffett gets excited. He knows that market downturns create opportunities to buy great companies at discounted prices. It's about doing your own research, evaluating companies based on their fundamentals, and not getting swept up in market hype or fear. By staying calm, rational, and objective, you can capitalize on the opportunities that arise when others are acting irrationally. Alright, let's dive into rule number 5. Prioritize value investing over growth investing. This is a core principle of Buffett's investment philosophy, and it's rooted in the teachings of his mentor, Benjamin Graham. Value investing is about finding companies that are trading below their intrinsic value. It's about looking for those hidden gems that the market has undervalued. Value investors like Buffett are like detectives searching for clues. They dig deep into a company's financials, analyzing their earnings, assets, cash flow, and future prospects. This contrasts with growth investing, which focuses on companies with high growth potential. While growth investing can be lucrative, it can also be riskier. Remember, investing isn't about chasing the latest hot stock or trying to time the market. Now, for rule number 6, we're talking about the people running the show. Invest in quality management. Buffett firmly believes that a company is only as good as its leaders. He seeks out companies led by ethical, competent, and shareholder-oriented management teams. Management makes all the decisions. They set the strategy, allocate capital, and ultimately determine the company's success or failure. Buffett looks for leaders with integrity, intelligence, and a genuine passion for the business. He wants to see a track record of making sound decisions, creating value for shareholders, and acting in the best interests of the company. Remember, you're not just investing in a company's financials, you're investing in its people. Make sure you believe in the management team and their ability to lead the company to success. Alright, let's talk about debt. Rule number 7 is a simple but important one. Avoid excessive debt. Buffett is notoriously cautious when it comes to debt. He prefers companies with strong balance sheets and manageable debt levels. Excessive debt can be incredibly risky, both for companies and for individual investors. High debt levels can limit a company's flexibility, reduce its profitability, and make it more vulnerable during economic downturns. If a company has a lot of debt, a significant portion of its earnings will go towards paying interest payments. This leaves less money available for investing in growth, paying dividends, or weathering unexpected storms. When you're evaluating companies to invest in, take a close look at their debt levels. Remember, investing is about managing risk, and one of the best ways to manage risk is to avoid companies with excessive debt. Alright, this next rule is crucial. Understand the difference between price and value. Buffett famously said, "Price is what you pay, value is what you get." In the stock market, it's easy to get caught up in the day-to-day fluctuations of prices. But price is not always an accurate reflection of a company's true worth. A low price doesn't necessarily mean a stock is a good value, and a high price doesn't necessarily mean it's overpriced. Buffett and other value investors spend countless hours poring over financial statements, analyzing a company's earnings, assets, cash flow, and future prospects. They're trying to determine the intrinsic value of the business. Once they have a good understanding of the company's intrinsic value, they can compare it to its current market price. Focus on understanding the true value of the businesses you're investing in. Alright, let's talk about emotions, because they can be a real killer in investing. Rule number 9 is all about staying disciplined and avoiding emotional decisions. The stock market is a roller coaster. There will be ups and downs, booms and busts, periods of euphoria, and periods of panic. It's easy to get caught up in the emotional swings of the market, but it's crucial to stay grounded and make rational decisions. Buffett's approach is to stay calm and rational, regardless of what's happening in the market. He doesn't let fear or greed dictate his decisions. He sticks to his investment principles, focusing on value, ignoring the noise, and making decisions based on logic, not emotions. By staying disciplined, avoiding emotional reactions, and sticking to your plan, you'll be well positioned to navigate the inevitable ups and downs of the market. And finally, let's talk about one of the most powerful forces in investing: compounding. Rule number 10 is all about harnessing the power of compounding. Buffett has often referred to compounding as the 8th wonder of the world, and for good reason. Compounding is the process of generating earnings on your earnings. The longer you stay invested, the more your returns compound, and the faster your wealth grows. One of the most remarkable things about compounding is that it's most effective over long periods of time. The earlier you start investing, the more time you have for compounding to work its magic. Even if you can only invest a small amount each month, it will add up over time, especially when you factor in the power of compounding. Remember, investing is a long game. The earlier you start, the more time you have to benefit from the magic of compounding. So, there you have it. Warren Buffett's top 10 investment rules. These principles have guided his investment decisions for decades, and they've helped him become one of the most successful investors of all time. Now, it's important to remember that these rules are not get-rich-quick schemes. They're not about timing the market or picking the next hot stock. They're about building a solid foundation for long-term investment success. They're about being disciplined, patient, and rational in your approach to the market. Remember, investing is a journey, not a destination. There will be ups and downs along the way, but by following these timeless principles, you'll be well on your way to achieving your financial goals. That's it for this video. If you found these tips helpful, give us a thumbs up and subscribe to the Investors Community for more videos just like this. Until next time, happy investing.